so what I have drawn on this board is those 4 stages again. We have an imaginary stock here. It could be any stock. And this is just general market cycle analysis and how the structure works. So what we have is first a stock that maybe has gotten hit, lower highs and lower lows. It undergoes that accumulation process. The accumulation is the process of buyers slowly regaining control of the stock from the buyers. So when we break it down to sub-stages, for instance, stage 1.1, that would be what we call early accumulation, mid-accumulation, and late accumulation. Now some of the differences between those 3 stages of accumulation are, one, the longer-term moving average will still be declining in that early stage 1 accumulation. It'll start to flatten out and might have a slight rising slope to it in the late accumulation. What we'll see is that in that late accumulation, we often have lower highs as well, kind of signaling that it's getting ready to break some resistance and create a pattern of higher highs and higher lows. Once it breaks that resistance and begins to emerge into an uptrend, this is where the buyers will take control of that stock. This is where demand exceeds the supply available that's being offered out in here, and the stock begins to rally. It'll often do that with a big burst of volume activity at first. Now, a big volume breakout is definitely what we want to see, especially early on. As the stock rallies, the pattern that we're going to typically see is that relative to the advances, we'll see the volume decline. So on these pullbacks, generally towards moving averages or retracements or whatever other tools you might use on a technical basis, it's important to see that the volume diminishes. Now, these pullbacks can either occur, again, by price, or it's even more bullish if it just kind of turns sideways in there. Maybe it builds a little flag or pennant or something like that. The ability for the stock to hold up without the price pullback indicates that there's still bidders in that market really looking to buy it, but they don't want to chase prices higher. Again, where has it come from? Where does it have the potential to go? If you're a big institution looking to accumulate a lot of shares, you're not necessarily going to pay offers, but you might bid for the stock so that you're going to be able to get the shares that somebody else might be looking to buy. Anyways, we want to see that pattern of diminished volume and then expanding on the rallies again. Now, it's not a huge thing to see that sometimes the volume of the second thrust might not be as strong as that initial break higher. This is a divergence, but it's not always indicative. And a lot of times, actually, it's not indicative that the stock's running out of steam or might pull back. However, that's just generally the pattern we want to see throughout the expansion of a price range. That is the uptrend, the higher highs and higher lows. We want to see volume expanding on the way up. It shows there's a real catalyst or impetus to get people involved. They want to buy all at once, but they're waiting for these pullbacks. Now, again, it could be the longer-term moving average. If we consider a daily time frame, for instance, this red moving average might be a 50-day moving average. And we might say, as long as the direction of the 50-day moving average is rising, the stock is innocent until proven guilty. We want to give the benefit of the doubt to the buyers. It doesn't mean we're going to be buying on these pullbacks. The idea of trend alignment is not to buy as the stock pulls back and not to buy as it settles in. Instead, what we want to do is we want to take a look at this type of activity and we want to expand it. We want to blow it up and kind of put it under a microscope. So if you could imagine that these are maybe some daily candles in here that look something like this. Okay? What we would then do is we would take a look at that on a shorter term time frame, and we would see that those 4 stages are kind of repeated throughout in here and on that shorter term time frame. So these might be the days, for instance. This might have been a 3-day rally, distributes for a day, declines a day and a half. And what we want to do is we want to look at this point right here. Okay? So here we have a short-term stage 2, short-term stage 3. We want to exit up in here after the stock has experienced a nice rally. We want to take our gains, or at least a good portion of them, raise our stops, and maybe be stopped out over here. The stage 4 decline, yeah, we can make money selling short, but again, the sum of the rallies is always going to be greater than the sum of the declines in an uptrend. So, and that comes also with the saying, news and surprises tend to follow the direction of the trend. A lot of times stock prices lead the news, and you'll see, well, why is that stock up? And then a week later, you'll see that some analyst upgrades them, or they get a new product or some kind of good news. Well, what we want to do is we want to avoid those stage 4 declines, not try to short them. If you want to short something, you pick on the weak stock, pick on the one that already has problems. Don't try to go after the biggest, strongest stock and think, well, it's up too much. Not compared to what the next guy might pay for it. So we want to avoid this stage 4 pullback. And in here, once the stock undergoes accumulation on the shorter term time frame, that's when we want to stock that stock. And we want to say, okay, we can see these little higher lows. Now, if it breaks this resistance level, here's where I'm going to come up with my plan. My plan might be, if this is $15.20 a share, I didn't draw that very well, but maybe I want to buy it on a break past resistance of 15.20 with a stop underneath the most recent higher low. Maybe that's $14.65, or maybe you want to use a more aggressive stop at $14.93. It's up to you to take a look at that short-term action and say, here's what makes most sense for me. But our action point is right here. When the stock makes that higher high on the short-term time frame and enters what's now a short-term uptrend, because we have this higher low, and now we have price confirmation. So we want to anticipate in stage 1 short-term accumulation when the primary trend is this big uptrend. So when we have a big uptrend, we want to look at that daily time frame and then drill down and say, okay, it's in a stage 4 decline, not interested. Stage 1 accumulation, here's where I'm going to start to anticipate. I'm going to do my homework, figure out where my stop might go, where that trigger point is. Is there enough potential upside if it just reaches this prior high? Or if it's truly in an uptrend on the daily time frame, well, this high right here, this is where we have this drawn to approximately, it should be able to continue to move higher and create a higher high on the daily time frame. If you think about what the long-term trend is, it's really nothing more than the sum of a bunch of shorter-term trends. So these short-term trends lead the long-term time frame. So stage 1 on the short-term time frame, anticipate. Stage 2, participate. Wait for price confirmation before you get involved. The risk in here is time. I can't tell you how many times in the past I've just been excited about a stock and really wanted to own it. I bought it in here, and then it just kind of goes sideways and then maybe drifts lower. Just because we view it as stage 1 doesn't mean it can't and maybe won't be, just a failure of this rally altogether. We want price confirmation. So anticipate, participate. Stage 3 up in here, we want to exit, take our profits, and move to the sidelines as it begins this fresh decline. So that's what we're looking at there. That's how we want to trade with trend alignment to the long side. If you think about on the opposite, when we have a longer-term decline, and maybe I should circle that with a red pen so we have a little bit more color up here. But when we have this decline, what we want to look at is we want to take that and we want to expand it. We want to blow it up into these shorter-term time frames and say, now what do we want to do here? What's our real plan of action? Well, when we sell short, we want to make money on the downside. So what we have here is, if we're taking a look at a shorter-term time frame, let me just erase these lines so we can do that. Well, that's not working very well. What we want to do is we want to look at this short-term decline, and then it begins this rally, and let's just say this was our prior peak right here. So this is approximately this point, okay? Now what we have right here is this point. So, and then the stock begins to decline again. So if we look at this, kind of similar to what we did over here, what we're going to look at is, here we had stage 3 distribution, and these might be days. Okay, here's our days when we blow it up on a shorter-term time frame. Well, what we want to do is we want to say, had we been short coming into this, well then, as it starts to turn sideways, we want to cover our position. We want to buy back. We want to take our short profits. If we sold short up at $42 a share and it's down at 38 and starting to turn sideways, good time to take those 10% profits. Now, as it begins to undergo accumulation, that's where we're getting out. This is where we exit in here. So we want to exit our position when the primary trend is stage 4. So that's this blown up again. Okay. So when the primary trend is stage 4 decline, we want to exit stage 1. Stage 2, we're just going to avoid that rally. Again, we can make money on these rallies on the bounce, but the odds just aren't as good. Why make things more difficult than they need to be? So we're going to avoid that stage 2. This is really where we get interested, though. This stage 3 distribution on the short-term time frame when the primary trend is stage 4 decline. So again, if we're looking at, let's say, a chart of 10 days with 15-minute data, and by the way, one of the best short-term moving averages you can use, in my opinion, for swing trades, is a 5-day moving average. It'll look very similar behave very similar to the way the 50-day moving average would on the daily time frame, as far as innocent till proven guilty and guilty till proven innocent. So we want to, when the stock starts kind of turning sideways, crossing above and below that 5-day moving average, then we want to say, okay, where's our trigger point? Where do we decide that the short-term time frame is now controlled by sellers? Because when the short-term time frame is controlled by sellers after this rally and sideways turn, then it should be ripe for further decline on the bigger time frame, the daily time frame. So right in here, this is our action point. This is the point where we want to get involved in this stock. And we're going to say, okay, here's where we participate. Okay, we anticipated in stage 3 decline, stage 3 distribution. We were anticipating. Now, here's the point where we participate in that weakness. This is where we sell or short our stock. We can either offer it out or we can hit bids, depending on how fast that stock is moving. That's tape reading skills. But we want to get involved as the short-term trend turns negative, because that puts it into alignment with this trend of the daily time frame or the next bigger time frame that you're looking at. You could even do this with day trades. I mean, this could be, this little red moving average would indicate a one minute or 1 minute chart using the volume weighted average price for the session. That's a lot of times, the same way that I'll use a 50-day moving average or a 5-day moving average on the short-term time frame is how I would use the volume weighted average price on a 1 minute time frame. That is, when that moving average is kind of turning sideways, it's just kind of neutral. Rallies above a rising 50-day moving average or a 5-day moving average on a shorter-term time frame or even shorter-term time frame, the VWAP, are innocent till proven guilty. Guilty till proven innocent when that moving average is heading lower. So back to our example of the short sale. If we decide we're going to sell short at $40.30 as it breaks below that support that has just come in, you'll see that it might have some lower highs leading to this breakdown. We sell short at $40.30 and set our stop either above the high of this stage 3 or maybe just above this most recent little lower high, whatever's more comfortable for you personally. But stage 3 is anticipated when the primary trend is a stage 4 decline. Stage 4 is participation. Stage 1 is exit. And stage 2 is avoid. And these cycles repeat over and over again on all different time frames. And what the Alpha Scanner allows you to do, again, is to take a look at different time frames and combine those time frames along with fundamentals. So if you're interested in a stock that pays dividends, why would you want to be interested in a stock that's paying 5% dividend but it's in a horrible downtrend? Simply doesn't make sense. If you're a value player, someone who's interested in something with a strong book, price to book or low PE or something like that, other value type of measurement, you might want to be really doing a lot of homework on stocks that are in that stage 1, 1, 3 on the weekly time frame, but have just begun a stage 2 on the daily time frame. So you have a little bit of momentum. Or a 1, 3 on the weekly and daily. So they're ready maybe to break out, but you can get into there and get into the real trends of that stock and say, does it appear to be late within the accumulation? Because if we can correctly anticipate and to anticipate. It allows us to not be influenced by price action, but instead to interact with the market on our terms, saying that I know specifically what I'm looking for. I'm not going to buy these short-term blips in a downtrend. I'm not going to be the sucker that falls for these things just because of an analyst upgrade or just because the company reports earnings or a dividend or a share repurchase. A lot of times, good news comes out on the way down, and all the bad news comes out where? At the bottom. Okay? Good news comes out at the top a lot of times in an uptrend because the market's a discounting mechanism. It discounts the past and anticipates what the future is going to be like. So people are buying stocks based on where they think the fundamentals will be 6 months out or whatever. But the point is, again, there's a lot of different ways to utilize not just trend alignment in the alpha scanner, but to make your timing decisions better. Whether you're a fundamental analyst, somebody who's just interested in price to book, PE, values, and that sort of thing, it's not a value if it's still declining. Okay? But if we've worn the sellers out, now it's reached an area of equilibrium on the chart as well. This could be viewed as a value area. That's where you want to plan your trades. And depending on just how deep down into the market you want to get, whether you want to be an investor, you want to be a day trader, or a swing trader, that depends on what time frame you're going to look at. And that's going to be different for each and every person out there. Some people just like the $2 stocks. Some people like trading $100 stocks. Just New York Stock Exchange versus NASDAQ or ETFs. All those things can be scanned for. Another nice feature is the short interest ratio. You can click on the scans and sort them by short interest ratio. And so if you have a stock that's just breaking out and it's got a big short position in it, a lot of times that becomes great fuel for the upside. Not only do you have people who are looking to get long that stock, but you also have people that are trapped in it, and maybe from higher prices, and they're short the stock, so they're going to have to buy it back to eliminate their or stop the bleeding in their accounts. So that becomes good fuel for the upside. You have natural longs, you have short sellers covering, and that sort of thing. So all these tools combined, price analysis, fundamentals, different time frames, that's really what's going to allow you to become much more accurate. First of all, in your entries, and making sure you're getting involved right as that momentum begins. That way you don't have to go through the stress of just waiting and watching and hoping. Instead, you're going to participate when the momentum just starts to come into that long side trade. You're going to participate in that short sale just as the fear begins to build again and those lower highs and lower lows come in. And hopefully you can repeat this process so you're just involved in getting really the sweet spots of the rallies and the sweet spots of those declines for, again, whatever time frame it is you might be interested in. If you're a longer-term investor, you might be starting out with, here's your weekly time frame, and you drill down to these daily time frames. Again, a lot of different ways to use it. Any questions you have, send them over to info@alphascanner.com, and look for some of our webinars that will be on the webinar page there. Sign up for that, and you can get your questions answered in live, in real time, when we do those on occasion. So thanks for tuning in and taking some of your time to listen to this presentation about trend alignment and market structure, and hope to see you online. Thanks.